Welcome to the Financial Planning Certification Exam Lessons podcast. This is going to be a sample lesson of the full series of audio lessons which are available at the website fplessons.com. That means financialplanninglessons.com, fplessons.com. At the website, you can find the full series of audio lessons. The full series of audio lessons consists of 6 different sections. Those sections include general financial planning principles, professional conduct and regulation, insurance planning and insurance products, investment planning, tax planning, retirement savings and income planning, and finally estate planning. A total of 6 different sections. You can buy the individual sections at the website fplessons.com. All right, let's get on to this sample lesson. This is audio lessons for the Financial Planning Certification Exam, Part 5, Retirement and Income Planning.
Hello and welcome to a review of retirement planning for the Financial Planning Certification Exam. This is episode 2. If you have not listened to episode 1 already, I recommend you doing so before you hop onto here. So in this episode, we are going to cover the types of retirement plans. But first, I kind of want to dive into Social Security taxation and reduction when you're working after retirement, because I feel like these kind of go hand in hand. So let's begin. Depending on when you were born, your full retirement age differs. So if you're born January 2nd, 1943 through January 1st, 1955, then your full retirement age for your benefits is 66. So after this age, you can work all you want and you can keep all of your benefits, no matter how much you earn. However, the caveat comes in if you are younger than your full retirement age. Then there's a limit to how much you can earn and at your job and then still receive some benefits. So that is the caveat. They want you to retire on time and not get your benefits too early. Otherwise, like this, you will kind of get penalized for it in terms of taxes and reduction in your benefits. All right. So kind of think of it like that, if you may. So, if you're younger than full retirement age during all of 2023, the government will deduct $1 from your benefits for every 2 you earned above $21,240. So that is just for loss of benefits. For taxation of benefits, it's different. So don't get the two mixed up. I certainly did. So let's separate these two into buckets in your head, okay? So now we're talking about taxation of benefits, all right? So if a person's income plus half of their Social Security benefits, okay? So income plus half Social Security benefits are more than the base amounts that I'm about to say, up to 50% of their benefits will be included in their taxable income. So these are the base amounts. $25,000 MAGI, that's very important, MAGI, modified adjusted gross income. So $25,000 MAGI for a single taxpayer and $32,000 MAGI for married filing jointly. So this is one of the odd situations where married filing joint is not just double the single taxpayer value. So let's remember these numbers. This is really important. Just to reiterate, your income plus half of your benefits cannot exceed $25,000 modified adjusted gross income if you're single, and it cannot exceed $32,000 MAGI if you're married filing joint. These numbers are not given, so you need to memorize them. So if you reach these thresholds, then up to 50% of your benefits are taxable income, okay? Doesn't mean you don't get them, right? This is not reduction. This is simply taxation. It's just included in your taxable income. So if your income plus half of Social Security benefits are more than the amounts that I'm about to say, will be 85% taxable. Basically, 85% of the benefits will be included in the taxable income, okay? These are the base amounts. They are $34,000 MAGI for single and $44,000 MAGI for married filing joint. So none of these numbers are indexed, by the way. It's just frozen there, which kind of sucks, obviously. Doesn't suck for the IRS, but sucks for us, right? So 50% if it's over 25,000 single, 32,000 married filing joint, 85% if over 34,000 MAGI single or 44,000 MAGI married filing joint. So this on the exam, it might be referred to as provisional income. So all provisional income is AGI plus tax exempt interest, which is your munis. So that's MAGI right there. And half of your Social Security income. So provisional income is basically MAGI plus half your Social Security income. Just a little note there. Know that if you see provisional income, you got an understanding. Moving on, we have two rules that we've discussed. So we've got working after retirement. Okay, so if you take benefits and then just keep earning income before your normal retirement age, then your benefits are reduced or withheld if your earnings exceed the threshold that I mentioned earlier way at first, not the taxation. And that's only if you're below your normal retirement age. After your normal retirement age, you can work all you want and, you'll get all your Social Security benefits, all right? That's the only time reduction comes in. Income tax on benefits, however, is if you take the benefits, then you have to pay income tax on the benefits if you exceed the thresholds that we just discussed a couple seconds ago. So keep those straight in your head. We got two buckets, right? We've got before NRA, we get a reduction, and then we've got, you're taking benefits and you're over the thresholds, and that's taxation. Just keep those straight in your head and memorize the threshold numbers. So I touched on this a bit in the previous episode. We're gonna discuss permanent reduction if you take your Social Security early. So if you're fully insured and you're a worker, you can start getting retirement benefits the month after you reach 62, okay? Or any month after, all right? So it just starts, I turned 62 in March, then, in April, I am allowed to get my benefits. But if me, the worker, or you, the worker, elects to start receiving benefits before my normal retirement age or your normal retirement age, the amount that you're getting for your benefit, it's reduced. So in this reduction, to make this reduction, you first have to calculate your PIA, and then the PIA is reduced by 5/9 of 1%, or 1/180. That's the more useful one. So memorize 1/180. This is very important. For each of the first 36 months that the worker is under the normal retirement age. So I don't know if this is completely correct, but something that just helped me was if I saw that I started receiving benefits 24 months before my NRA in the problem, I would put 24 over the 180. Okay? And that would be the factor in calculating your PIA. Obviously, there's calculations involved, and you have to look over this. You can't just, learn it by listening to it. The 1/180 is very important. Just know that's the number of months. So when you see months, put it over the 180, okay? So if your benefits start 24 months before, we put 24 over 180. If they start 36 months before, we put 36 over 180, and then multiply it by the PIA. It's a little confusing. So make sure to take a look at that, and that's pretty important to understand and to know where those numbers go and to be able to calculate that. So I feel we've covered that pretty well, and we're ready to move on to the types of retirement plans. There's some overlapping and some considerations, so I wanted to include them in the same episode. So let's just dive in to money purchase plans. So a money purchase pension plan uses a benefit formula, and it requires employer contribution, and it's a flat percentage of each employee's compensation. So employer has to contribute, and there's a flat percentage of the employee's compensation that's being contributed on the behalf of the employer, or from the employer on the behalf of the employee, I guess you could say. That was confusing. Keep it straight in your head. Employers contributing pension plans. I think this is common knowledge, so let's move on. So contribution percentages are up to 100%. You can contribute 100% of someone's income. Only the first 330,000, which is 2023's number, of each employee's compensation can be taken into account, right? That's the 330K is the covered compensation limit. So if there's a flat percentage, let's say 1%, and the employee makes 400K, you can only multiply the 1% by 330K, not the full 400. Okay, so the covered compensation limit is 330,000. However, the employer can only deduct up to 25% of total plan compensation or eligible payroll. So there's a difference between contributing to accounts and what an employer can deduct. So the maximum annual contribution that an employee can receive is either the lesser of 100% of salary or $66,000. And I'm pretty sure the math works out like this. $66,000 is 20% of 330,000, okay? So that's where that $66,000 comes from, the covered compensation limit times 20%, sorry. So 20% of 330,000 is 66,000. That was kind of an aha moment for me, and that'll kind of help you along in the other explanations. Let's continue. So when are money purchase plans appropriate? It's when the employer wants a stable workforce, right? You really want to retain people. In this day and age, pension plans are the creme de la creme. An employer wants a plan that is, simple to explain and to administer for a pension plan. That's a key one in there. Money purchase plans are very simple to administer for a pension plan, and they're also very easy to explain, right? It's just, it's a flat percentage of your compensation. That's important. Let's keep that in mind. And all the employees are relatively young and pretty well paid. All right, that's when it would be fit. So what are some requirements to have a money purchase plan? If you're in any pension plan or looking into one, you really have to have a very stable cash flow and profit, because you have to make annual fixed contributions. Doesn't matter how horrible, how great the company's doing, it's a fixed amount. So very stable cash flow. And the factors that affect a employee's retirement benefits are years to retirement. The retirement benefits may not be enough for employees who enter the plan at older ages. That's why relatively young and well paid is part of the appropriateness scale or determiner, okay? So years to retirement. We've got investment returns. So the employees actually bear the investment risk under the plan. This is because it's defined contribution. So it's a pension plan, but it's a defined contribution pension plan. It still has the same risks as your 401k at work, right? Because that is defined contribution. They're putting that money in every year, but the amount that it will grow to is completely up to the market, and the employee bears the risk for that. It's not a defined number that they're paying out. It's a defined number that they're paying into the plan. Salary levels, because contributions are based on a salary for every working year rather than, your salary at retirement, because it's, again, a defined contribution plan. And employer contributions, it's kind of obvious, but there are minimum funding standards, but employers may make contributions as low as 3%. I guess that 1% example I said earlier is null, but it illustrated the picture it needed to illustrate. But yeah, your employer is contributing and they're contributing consistently, but it just might not be enough. We've got forfeitures. Okay, so forfeitures actually, it's good or bad depending on who you ask, actually. So forfeitures basically can either be reallocated to the participants, which in that case would be very good if I am a participant, or applied to reduce the employer contributions. All right. In that case, it's great for the employer, definitely not for the person that forfeited the money. But, that's not my problem. Moving on to target benefit pension plans. So this is also a defined contribution plan, and it's pretty unique because it includes some features that are associated with both defined contribution and benefit plans. So these are some qualities that they share with defined contribution plans. We've got the maximum contribution, that's the lesser of 100% of compensation, or $66,000 for 2023. Retirement benefit is determined by the balance of the account, not a promised amount. It is the account balance. And there's no annual actuarial determination for this type of account for target benefits. There's no actuary needed. The employee assumes investment risk, obviously, because, your benefit is based on your account balance. So the employee bears the risk. And forfeitures can be reallocated or used to reduce employer contributions. So that's what they share with defined contribution plans. These are some of the characteristics they share with defined benefit plans. The plan generally benefits older employees because there's a target benefit that they're going towards. So opposite of money purchase, target benefit actually benefits older employees. An actuary determines the initial contribution level. That's important, right? So there's no annual ongoing determination, like we mentioned in defined contribution, but an actuary has to determine the initial contribution level. And then also in common with defined benefit plans, target benefit plans have a fixed mandatory contribution. So let's discuss how this is designed. So an actuary sits down and evaluates and determines the amount of funds that are needed for a even annual employer contribution using interest and actuarial assumptions with a benefit formula. Okay, so do you see how it kind of has the best of both worlds, if you will? The level contribution will not change, except to obviously reflect new people participating in the plan, and it increases in the compensation of existing plan participants. So once the plan is established, the employer hopefully can provide a specific benefit, the target benefit, if you will, at retirement. So I love, how there's, hope in there. However, the employer is not guaranteeing that the target benefit amount will be paid. They're setting a target, and that's good and dandy, but investment risk does fall on the employee at the end of the day. So when would a target benefit plan be appropriate? You should see it as an alternative to a defined benefit plan that provides adequate retirement benefits for older employees, but also has the lower cost and simplicity of defined contribution plans. Again, let's reiterate: adequate benefits for older employees and lower cost and simplicity that you find with defined contribution plans. Moving on to profit sharing plans. So it is a qualified defined contribution plan that has a flexible, keyword, flexible employer contribution provisions up to 25%. So, qualified defined contribution plan that's flexible with employer contribution provisions up to 25%. Before the Tax Act of 2001, profit sharing plans were limited to 15%. So in the past, a tandem plan was 15% profit sharing, 10% money purchase. So now there's no need for tandem plans after the Tax Act of 2001. Not sure if you're going to need that for the exam, but it's good to know conceptually, and also if you dealt with tandem plans in the past. So, features of profit sharing plans. We've got the employer's contribution to each plan year, and that amount can be purely discretionary or nothing at all. Okay? So it's either an amount or nothing. So the contribution from the employer is completely discretionary, and they can also put nothing at all if they wish to. So the employer will not have mandatory contributions that they have to abide by or minimum funding requirements, but there's a little rule in there that says payments have to be substantial and recurring, whatever that means. So the IRS does not really specify frequency or amount to satisfy this rule, but it's based on like a reasonable person, right? So if too many years go by or too little dollars are contributed based on the circumstances, then the IRS could perhaps retroactively disqualify the plan, or they could just consider it terminated. So that's something to keep in mind. Very loosey-goosey definition, but at least, it's still there to protect the employees. All right. Each participant has an individual account, so money's not pooled together like some of our pension plans are. Everyone has their own separate account. And the account balance is a melting pot of employer contributions, investment returns, and forfeitures. So forfeitures are basically, again, in this context, unvested, terminated employee account balances. So actually, in this case, they're normally reallocated to plan participants. You might be wondering, why didn't it include employee deferrals or contributions in that account balance composition sentence? That is because profit-sharing plans are not 401k plans. 401k plans are profit-sharing plans, but a normal profit-sharing plan is not a 401k. Why is that? When you tag on the 401k at the beginning of a profit-sharing plan, that is when employee deferrals are allowed. We'll discuss that in a second when we get to 401ks right after this, but I'm sure that question popped up in a couple people's heads, and I wanted to address that before you go into a self-spiral, all right? So that's also a very important distinction. They'll try to trick you and not mention the 401k and see if you'll answer it like a 401k, okay? So profit-sharing plans, it's only the employer contributions, investment returns, and forfeitures, all right? So when would a profit-sharing plan be appropriate? When the financial stability or profit margin of an employer kind of varies. It's not really stable, right? Also, when an employer wants to adopt a qualified plan, but with incentives to motivate employees to make company profit, because if the company does good, we'll put money into your retirement account. And then this is also for young employees that are well paid and have a good amount of time to accumulate their retirement savings. So that's just profit sharing plans. Now let's move on to 401k plans. I think this is the last one I'm going to touch on for this episode. So a Section 401k plan is also known as a cash or deferral arrangement, or CODA plan, okay? So keep those two very close in mind, right? So a 401k can be attached to either a profit sharing or stock bonus plan, where plan participants have the option to put their money in the plan or basically receive the same amount as taxable cash compensation. So you're either deferring it or it's kind of like a bonus type thing. So if an employee elects to defer, the deferral is still subject to FICA and FUTA taxes, okay? That's very important. You defer, you still pay FICA and FUTA, all right? So the limit on elective deferrals is $22,500 for 2023. This number is provided on your tables, and the catch-up is in 2023, $7,500. And that catch-up is allowed if a participant is age 50 or older. So those are besides the age, the catch-up and the deferral is on your tax tables. A little update with the Secure 2.0 Act. We've got over 50 catch-ups are going to be taxed, basically. It's going to be treated as a Roth contribution if you do the 7,500 catch-up. So this starts in 2024, and if you earn more than 145,000 a year, your catch-up contribution is going to be treated as a Roth contribution. Basically, your catch-up is included as taxable income. You're going to be taxed on it. That's something to note. I don't know if it's going to be on the exam or not, but it is new, a new act. So keep that in mind. So when is a 401k appropriate? It is when an employer wants to provide a qualified retirement plan for their employees, but can really only afford very minimal extra expense beyond salary and benefit costs. And also when employees want to increase their savings on a tax-deductible basis, right? So anytime you hear an employee, right, wants to defer some money, think 401k, all right? Anytime you hear an employer and no mention of an employee contributing to accounts like this, then you're just doing like a normal profit sharing, right? Keep that in mind. This concludes episode 2. In this episode, we covered working after retirement and what that entails, including reduction of benefits, taxation of benefits, and permanent reductions. We discussed money purchase pension plans, target benefit pension plans, profit sharing plans, and 401ks.